All right, good afternoon, and welcome back to the Money Advantage podcast. I just realized we are 2 minutes early. Bruce, this has never happened in the history of the podcast. I just took us live and I didn't realize. So today we're talking about the news that you might have heard. There is a lawsuit against Pacific Life about a policy that Kyle Busch, NASCAR driver, had that lost him millions of dollars. And so we are talking about that conversation today, what happened and what you need to know to be able to navigate around and not have yourself fall prey to concerns like this, and really talk about how it happened and what that means for you. Bruce, thank you for bringing this up and being willing to have these conversations about things that really are top of mind for people right now.
Yeah, I just wanted to not necessarily dive deep into this, but keep this at a higher level so that people can get more educated on the pros and cons of different insurance companies, the pros and cons of different designs, and the fact that we want to remind people that Nelson Nash himself actually warned against using universal life products, especially for the infinite banking concept. He actually said it in his book. And I've actually have used these products on occasion, but not for infinite banking, more for estate planning. And they are products that they seem like they are being transparent with the products, but it comes down to, like any company, they're marketing certain attributes. And if a person doesn't understand the marketing, then they can get sucked in to the sensationalism of the product. And then the other thing is that, and we're going to talk about this before the end, is just like Nelson said, a person's behavior is much more important than the policy design. And frankly, the Bushes, Kyle and Samantha Busch, have to take some responsibility for this because they didn't follow through and fully fund like they said they were going to fund it. And I'm sure that the lawyers for Pac Life and the lawyer for the insurance agent is going to bring that point up. But as the article that we're going to reference states, that even if they would have fully funded it, um, it wasn't built to where it could be even successful. And so the last thing before we dive into this is that we're going to reference a article by Bobby Samuelson, and Bobby Samuelson is kind of like a pillar that most of the insurance industry looks to when there's product design questions. He used to actually be the head of product development at and pricing at Bright House. Excuse me, I don't know how I had Price Waterhouse and at Bright House, and that formerly was MetLife's, and a lot of people have heard about MetLife retail division. Um,
Okay.
so Bobby is, if you're not in the insurance world, a lot of people wouldn't know who Bobby Samuelson is, but if you're in the insurance industry, you would understand that he has a lot of credibility when it comes to product design and pricing, which includes compensation, which includes crediting and whole life, and includes how they price the cost of insurance, so on and so forth, and the dividends. Now, what Bobby doesn't have, and if I was talking to him personally, I would say this: Bobby doesn't have the knowledge of actually working with thousands of clients, and that clients' behavior is also very important in any insurance product. So I just wanted to pre-frame that, where we got this information from, so on and so forth.
Excellent. So, a couple things to just note at the top of this, and then we're going to dive into what happened, what it means for you. There was a recent lawsuit against Pacific Life. It was brought by NASCAR's Kyle Busch, and this exposes some of the most dangerous trends in finance today, insurance being sold as an investment. We're going to come back to that idea later. Insurance is insurance. Insurance is not an investment. At the center of this case, there was a complex indexed universal life policy. Bruce mentioned this a second ago, where he said Nelson Nash, the founder of the infinite banking concept, does said do not use IULs, that's indexed universal life insurance policies for infinite banking. This is the type of policy, an IUL, that was used, and not just any IUL policy, a very complicated IUL policy. There was a lot of overambitious projections, there was a lot of risky assumptions, and there was a compensation system that rewarded sales volume over client outcomes, or it promoted agent compensation over what was best for the policyholder. And so now we're looking at a high profile lawsuit that is shining a light on a problem that impacts thousands of families across the country. And really, when I say that, the problem is not that your life insurance is at risk. The problem is it can be perceived now as life insurance is risky, but what is important to understand is why that particular situation ended up the way that it did. And that's what we're going to unpack a little today. So, we're breaking down what this case reveals about IUL products, about agent compensation, and really how to protect yourself against losing money in poorly designed policies. So, we want to ensure that we're prioritizing guarantees, transparency, and control, not sales hype. So, Bruce, as we kind of start this whole conversation, just in case somebody hasn't heard of this, can you just kind of walk through what happened in this Kyle Busch versus Pacific Life case? What was yeah, not even just the core issue yet, but what happened?
Yeah, I think apparently, and once again, I'm going from Bobby Samuelson's article that he claims he's actually seen the illustrations. I don't know. I don't have that fact, but I don't have any reason to think he's lying. But the only way that you could actually know the facts is if, or at least a lot of the facts is if you have the illustration. He claims he has those illustrations. Now, how I obtained them, I have no idea. But basically, apparently, Kyle Busch was approached by somebody and his wife, Samantha, that they could use these index universal life as passive income for retirement into the future, and that it would be a great investment for them. And so that was part of the problem is that they understood it as being an investment. Um,
Bruce, just watch the papers on your mic, make it so it's hard to hear you.
thank you, thank you. That the investments, I'm glad my mics are that sensitive, um, but investment, and so uh, they didn't really talk about the death benefit, and that's part of the lawsuit is because the way that they increase the compensation is by actually increasing the death benefit. And not one time, according to the lawsuit, does Kyle Busch actually talk about wanting the death benefit? And doesn't seem like the agent was actually even talking about the death benefit because he was talking about how it could be used for retirement income. However, the death benefit was really, really high, which increases agent compensation. It also increases what we in the industry a lot of times talk about a hurdle to overcome so that the policy can perform. And what is that hurdle? That hurdle is the compensation that must be figured into the pricing by the by the insurance companies so that they can pay the compensation and still make the contract work. And interestingly enough, Pac Life has something that you can increase the death benefit called annual renewable term, but for whatever reason they don't in this particular product they don't pay commissions to the agent for this particular annual renewable term, so they're like de-incentivizing the agents to actually use that to keep the cost down. And so it looks like the Pac Life is incenting agents to actually sell this product by having great compensation. Now, the cynical person in me says these companies don't care because they'd like to keep them on the books for a while because they have to recoup what they're paying these agents. But if they if they lapse, that's future liabilities that go off the books. They don't have to pay. In other words, they don't have to pay the death benefit.
So I think what you're saying, Bruce, is this particular insurance company, Pacific Life, you're saying had a flaw in the way that they were structuring things by making it look really good for the agents up front, high compensation for the agents, where the that particular life insurance company, you're not generalizing to all life insurance
No.
companies, but that particular company was less concerned with the long-term performance and the long-term stickiness, the keeping of a policy throughout your life, and they were more concerned with, I would think like a shotgun approach, get a lot of policies,
Right.
and if the people who own those policies, the policy holders, cancel them later, which is what would be considered lapse in regular language, that would be policyholders canceling. That's no big deal to the company, right?
Yeah, exactly. So because they're looking at future liabilities. And I'm not saying it's the whole company, but at least in this product, Bobby Samuelson was saying that this was a flaw in this kind of product that they were producing. He also says that one of the problems is these policies were positioned as investments that would deliver tax-free retirement income. And the claim is problematic because the language shows up in some of the emails that are included in the lawsuit, including from people at Pac Life. So apparently, people internally from Pac Life would, whether it's a wholesaler, internal or external, or it's somebody from Pac Life itself, are referring to these as investments that would provide tax-free retirement income. Now, when we talk about income in the future through whole life, we don't talk about it as being an investment. We say you can get passive income from this in the future, but not from an investment portfolio. It's actually from the portfolio of the life insurance company, and your cash value is not an investment. It's simply the net present value of a future death benefit. And so we don't talk about being an investment. We talk about being a place to store your money, and that cash value will then represent what you will have into the future as far as the net present value of future death benefit. So obviously, as it grows, you can access it according to IRS tax laws, and you could use it for passive income in the future. So
So Bruce,
this seems to be a really big problem for not only the company but also for the agent.
would it be fair to say as well that when you're looking at a whole life insurance policy, you have a guaranteed cash value, a guaranteed minimum cash value dollar amount, so you know what you could, at a very minimum, if the policy never paid a single dividend, you know what your cash value would be, so you could know what amount you could take out at a very minimum in the future. Whereas if you're looking at an IUL, the cash value is based on stock market performance. They might have a zero threshold or a zero floor, but you do not have a guaranteed cash value amount. Is that also part of this equation?
It is part of this equation because there are no guarantees in this, and these policies also do not go through a process of what they call endowing. In other words, they're going to be paid up. These policies can never be paid up. And so that is very, very important when you're looking at this process. So what's interesting, what I find this interesting is Bobby says, but neither of them individually or together can explain the astonishing loss of $8.5 million on a $10.9 million of premiums paid over just 7 years. And he says permanent life insurance is simple products. Premiums go in, policy charges go out, and whatever is left earns interest. Cash value is the balance of that equation. But the Bushes lost 8.5 million on a product with a zero crediting floor. Now I'm going to quickly explain that. So there are assumptions being made in an index universal life. Index stands for just what we talk about in the investment world, an index of a basket of investments. So most people equate that to the S&P 500 index. It could be the NASDAQ index. It could be the Russell 2000 index. And there's a variety of indexes that other investment companies make up their own indexes. But it's what the way that these indexes work is, let's just say it's the S&P that has a certain amount of points on a certain date, your anniversary date. Let's say it's May 1st. Then that index can go up and down the entire time. And then the next May 1st, if there's a positive number, in other words, the index was up over that 12-month period, they will then give you a portion of that index according to the contract. And those are called caps and participation rates and so on and so forth. We won't go into all that today, but basically you're going to earn some of that interest from that index on into your policy's cash value.
So
They
fair enough,
also,
fair to say that if the index over 12 months went up by 8.1%, that doesn't necessarily mean you're going to have 8.1 growth on your policy. If your participation was less, it might be a 4% crediting that happens on your cash value, correct?
correct, and they're going to have what they call caps. So they're going to cap what you can make. And why do they cap what you can make? Because they also cap that you can't make any losses from the index. So the floor would be zero. You can never lose any crediting from the index going below that year. So if the index is actually in a negative at the time when your anniversary date is, you would get zero crediting. So then what they tried to show on the illustrations is what is the average crediting over the life of this. And we all know from average and actual that that crediting is not also not helpful. And you throw a zero in there, and then you're not going to get anything close to what the illustration shows. So what happened here? If the Bushes lost $8.5 million on a product that does have zero crediting floor, then it seems there can be only be one explanation. Well, it had to be from extensive agent compensation to lose all that money in a short period of time. And that's exactly what Bobby is saying here. He's saying that this exorbitant agent compensation called enormous policy charges that ultimately resulted in losses. He says it's about the unique way that Pac Life has approached agent compensation for the last 40 years. And one agent who decided to push, now this is where he's saying the agent, not the company. The one agent decided to push the compensation to the absolute limits for his own benefits. So we're once again telling you that this is not indicative to every agent, and it's not indicative to every company, and it's not indicative to every product. You have to choose to do this. But undoubtedly, Bobby says critics of life insurance will say that this case is indicative of the normal policyholder experience. And he says that is absolutely and unequivocally not the case. Life insurance policies used for accumulation and funded at the maximum non-MEC premium effectively can't lapse. That's literally how maximum premium limitations are calculated. And Bobby says, I own policies and they do fine. I own policies too. And I fund them and they're not even anywhere near lapsing because I fully fund it.
And
So
yet
that,
Bobby, or not, no, Kyle Busch's policy lapsed, and that's where he lost all this money. So the policy he was putting in, I think it was 1.5 million per year over 5 years. So they say the 5 pay was not an efficient way of structuring this based on the 7 pay MEC test rules that are required anyways in the first place. But he was funding it 1.5 million over 5 years. There was a portion of time that he didn't pay the full premium, as you had stated earlier. But what happened is that then they lost $8.5 million after having paid 10.9 in premium over a total of 7 years, and the policy wasn't it lapsed. It
yeah,
which means the policy closed, and there was a detriment, a loss of that $8.5 million of cash value or of premium that had been paid in that was not available in terms of cash value to pay back to him when that policy was canceled.
correct. And once again, I just want to reemphasize that we are restating a article by Bobby Samuelson of his thought process that most people in the industry really respect his knowledge of how these work. And so he says in his article, how is this possible? The only way to know for sure is to see how the as issued illustrations. And he says, I have them. Okay. So he's saying he has those illustrations. So he says these policies were built to fail at the very beginning. The experience that Kyle and Samantha Busch had with life insurance is in no way an indication of what is normal. Okay, so he wants to emphasize, and remember, Bobby is not an insurance agent. Okay, he is a product expert on design. Okay, so he's not saying this is indicative of the normal people. He says, but the fact that it happened tells us that they are assuredly not alone, and for that reason, we have to reckon with what this case shows us. So what he's saying is there could be other people out there that this has happened to them too. And so he wanted to go through this. So what was interesting, and there's some other issues here, is that the agent, we already talked about this, put the death benefit very, very high. And because of that, Kyle Busch is a NASCAR driver, which is a dangerous profession. So it added what they call flat extra per thousand of mortality costs or cost of the insurance, which drug the cash value down even greater. And it was going to happen for 20 years. So this 20 years then was going to be additional hurdle that the index would have to overcome. Um, and it's really bad because it's $44.5 million of death benefit that he had to pay all these costs on, even though he told the agent that he did not want to do, well, I shouldn't say he didn't tell him that he didn't want it for death benefit, but that was not the goal. The goal was for passive income. So bringing the death benefit down would have been the thing to do. However, then he wouldn't have been able to put $1.5 million in the first year. And so the agent decided to do higher death benefit so he'd get 1.5 million. Why? Well, Bobby's saying it's because that way he got paid more. Okay. What he could have done is he could have spread out the payments instead of 1.5 over 5 years. He could have spread them out over 7 years, and then that extra 500,000 he could have put in year 8, and it would have been much better. Wouldn't have to have the highest death benefit, thus the extra costs would not have eroded into the cash value, and you would have not had the same agent compensation. So
I mean, that just makes me think that when you are meeting you as a person who is looking for life insurance, you're talking about your goals, you're talking about your financial situation with a life insurance advisor, with a financial planner. It's really important that the your situation, your goals, and your intentions, what you're setting these products in place to do, is the is taken into consideration in terms of product design. And Bruce, what you're saying is it wasn't, because that additional amount of death benefit, you could say, well, maybe the agent was just being nice and building this in because he knew that a higher death benefit would have been good for the Bushes. But if you are not disclosing that fact, if it's not something that is desired by the client, it's not something that should be just added on for the sake of something that is a tremendous benefit to the agent without proper disclosure.
yes, and once again, um, I think the Bushes have to take some responsibility on this, but they're looking at people to be the experts. Um, and they should have known it was $44.5 million of death benefit. And they should have known that that's going to cost a lot of money to have that much death benefit, especially if you're a race car driver. And if they didn't do it, well, then I'm really surprised that they were that trusting. I really do believe that. Um, what's interesting is he says right here the total cost of the insurance, including the flat extra tally, comes to $2.2 million on Pac Life's current sold IUL2, which is virtually identical to the designs of their previous PDX2 and serves as a proxy for Kyle's policy. Without the flat extra, the total cost of insurance would have been just $181,000. So you can see how the increase of the additional cost of the insurance because he was a race car driver really did impact this, because Bobby's saying that the cost of the insurance was 2.26 million over that time period, where if he didn't have that additional flat fee, it would only been $181,000.
I mean, just in rough math, Bruce, is that's like 20 times higher cost of insurance than it
Yeah,
could and should have been.
right. And that's because and then the next paragraph, he says that's because the extra death benefit is always suboptimal for accumulation designs. And that's why when we do the infinite banking concept, we try to pull the death benefit down as far as possible so that the cost of the insurance is less, so that the cash value accumulation can be a lot higher for people. Um, he said, why did the agent set it up this way? He said, well, we could maybe have given him the benefit of the doubt and said that it was a good thing that the NASCAR driver had a lot of insurance, because it's a dangerous occupation. But he says, but nowhere does the desire for death benefit come up in the lawsuit or in any of the emails that he had. More death benefit equals higher target premium, and there is little justification for this death benefit this size other than increased commissions. So Bobby has come through that. Now, here's where I was talking about. The agent could have stopped there, but he didn't. Rather than using commission-free annual renewable term. Once
That's
again,
what I thought it meant, Bruce, because the words were different. It said commission-free art
ART,
coverage. Yeah.
ART.
And I was going to ask you, is that the same as the term rider that we're
Yeah,
more familiar with within the products that we use? So he could have gotten the same amount of death benefit in a different way that wouldn't have paid him so much commission, but he chose not to do that. He chose to build the policy with very high commissionable death benefit.
correct. And this is where Bobby says Pac Life has to be somewhat held responsible for this. Because why would they not pay a commission on the annual renewable term and de-incentivize people to not use it? Because that's what they're doing. But he said they could. This is what really interesting. And this is why Bobby says that he believes the agent was was actually looking for commission, because he says Pack Life sets its default. In other words, its illustration software is set to default basic coverage split and the annual renewable term at 50-50. So they would have brought the basically the base death benefit down to only 50% of the target premium, and then 50% would have been the annual renewable term. And it's set like that. So he had to mindfully change that on the illustration software. And the only reason he would change it is so he would get paid more.
And what's interesting, I mean, I know you know way more about this, Bruce, but in my understanding, usually the reason to add additional death benefit on is to ensure that you're not mecking a policy.
Correct.
But you could add that death benefit coverage as a term rider and overcome the same challenges of mecking a policy. You don't have to add it with fully commissionable base death benefit coverage that pays a much higher commission.
Yeah, I mean, beautifully said. Um, what's interesting, it says on top of that, the agent issued the policy with an increasing death benefit in year one, with a plan to switch it to a level death benefit in year two. He said the charitable rationale, in other words, he's trying to give the person benefit of the doubt, is that the agent was trying to increase the GLP and GSP limits, but that could have easily been handled by just using the CVAT limit. And that's the cash value test limit those are cash value test limits for the MEC test. So
I
he
looked
was
up
trying to make
GLP
sure.
was guidance level premium and guidance single premium.
Correct, correct. And the reason it seems is it was a further increase, Bobby says, the commissions. And that's why he needed the higher death benefit. What's interesting is, to me, is that the target premium with 100% basic coverage jumps from 550,000 and some change to 1.494 million, which is probably not a coincidence that the target premium was just a hair off the plan premium of 1.5 million. In other words, he was saying that he could have gotten the same results with a different design, but then the target premium would have only been 550,000 and would have been paid on 550,000 instead of 1.49 million. And so he says Kyle and Samantha committed to 1.5 million, and then the agent worked the policy to get the compensation to match. He says by every indication that's exactly what happened because he had to change the illustration software to manipulate it like this.
Which, Bruce, it makes me think that if a client really did, if the Bushes really said, I do really want to put 1.5 million. Now I'm going to change the whole scenario, which I know is not what they were doing because they're using an IUL. But if they literally said, I want to put 1.5 million in for the purpose of banking, and I want to use this for infinite banking purposes, and here's how much premium I want to put in because I want to build the cash value a certain way, then under that circumstance, the policy would have been also designed completely differently because the death benefit would have been significantly reduced and the cash value would have been significantly higher in the early years, correct?
Yeah, well, I would say the only thing is that they couldn't have pulled down the death benefit that much because then it would have mech'd. But what Bobby's saying is he could have used less of the target or the base premium, and he could have used annual renewable term that the company then would have known it would have either blended out or it would have removed. And so they know they would have had less long-term liabilities. So then the premium, the cost of the insurance would have been brought way down because they knew they didn't have to carry this premium out forever.
Got
So
it. Got it.
so they wouldn't have been able to bring it down so much, but they would have been able to bring down the expensive part of the cost of the insurance.
So
Absolutely.
do you feel that they still could have put in 1.5 million into a policy if they wanted to?
Yes, if they would have used the annual renewable term rider that he was talking about,
Yes,
they
which
could have
then
done
would have had a lot higher cash value comparatively than what it had.
and more importantly, less cost.
Yes.
Because one, he wasn't going to get the agent wasn't going to get paid on the annual renewable term. Okay.
Mm-hmm.
And two, that term would have uh, been either blended out or got less and less over time because it was a level. It was a level, it wasn't increasing. And thus, as the crediting increased, then the term would have been decreased along the way. So,
Now, I just want you to, as you're listening, if you're hearing right now, we're talking about a lot of technical details. And before you tune out and say, I've heard this from people before they might approach the life insurance conversation. I was just talking to someone this week that said, I feel like it's so complex. I can't understand it, which is why I'm not ready to jump into infinite banking or I'm not ready to jump into life insurance because it's really complicated. I think it's this particular lawsuit, this particular situation has the potential to make people feel like it is such a confusing, complicated situation that they can't know how to proceed. But Bruce, I just want to pause here and acknowledge that, especially if somebody's hearing, look, I just want to store capital. I want to be able to use this for infinite banking purposes. I want to be able to have a I want to be able to control capital. I do want to put a lot of premium in. How is this a lot different? How do I not need to get bogged down within these details of how much is which type of premium, which type of death benefit, which the structure of the design? How do I as a consumer interface with what you're saying right now, Bruce, about all of these levers inside the policy that cause this complication? How can we simplify that for them and make it clear for somebody who does want to use life insurance well? And I know this might not be the right place for it. I just am sensing that there could be that person confused right at this point in the
yeah, well,
conversation.
I think they need to get their questions answered about how is this design minimizing commissions? That would be the easiest way just to ask a client. Um,
To ask the agent.
or ask, excuse me, to ask
Yeah.
the agent by the
Hmm.
client. Um,
Excellent.
but what this is a great time to bring this in because Bobby, once again, Bobby is a pricing expert. Okay. And he says speaks to something of a truism in life insurance. Commissions don't matter if the illustrated rate is high enough and the illustration runs long enough. Time and performance always outweigh initial policy charges over the long run. In other words, commissions have very little to do as long as you're thinking long range, because then those charges get spread out over a long period of time, and they don't have a lot of impact on the performance of the policy. And it's funny, I would say a good 12 years ago, I was actually at a life insurance conference, and one of the agents raised his hand to the president and said, the dividend rates are so low right now because the interest rates were so low. He said, I've been talking to a lot of other agents. We will actually take less commission if you can raise the dividend rates. And he goes, commissions don't really move the needle. They don't move the needle as far as returns inside a policy if it's long enough. And it makes sense because, we're talking about these policies that you're getting commissions, first year commissions, and then these policies are actually designed to go out to age 121. So they're actually amortizing these charges over a long period of time. And so it's really not going to, and that's what moved the needles. And that's why we talk to people all the time to think long range. It's funny in the investment world, they talk about B shares and A shares and C shares for mutual funds and variable annuities. And they say if you're going to be an X type of investor, you need to use this share class. It's just, and basically it's just a fancy way of saying, do you want to pay the commissions up front or do you want to pay them at the end? And so you just have to figure out, well, if I pay them at the end, then I'm going to be better because I've spread them out over the entire time. But if I pay them at the front and then I get out of it in a short period of time, then I paid all the commissions up front. So this is something that people have to realize, that commissions do matter, but they don't matter if you think long term, or at least they don't matter as much. And people say, well, why do they even have to be commissions? Can't we just buy this on a website? You know, well, websites are expensive, and we've already talked about these are fairly not complicated, but you're not used to how they work. So you need a trained individual to actually explain it to you and walk you through the process. And that's what they're getting paid for.
That's very well said. And I think, I mean, he said later on in the article that part of the reason for upfront commission is an incentive for the life insurance agent to do the hard work of helping educate people about something that's really good for you that most people are not actually looking to buy
Right,
because
right.
they don't understand it to begin with. And Bruce, I know that you're going through this next component of the Bobby Samuelson article. I like how he pointed out this is that thinking long range, I think is really, really, really valuable because you need to think about what your decisions are going to create far into the future. But there's another component of this that this particular life insurance illustration brings out. And I know that this was the next part of the article. And he said, this illustration for the Bushes illustrated really well with 787,000 of annual income between ages 51 and 80 if you
Yep.
looked really far in the future and had an internal rate of return IRR of 6.09%, which looked really good if you put the money in, don't look at the immediate performance and look really far out into the future, which we do encourage you to look long range. But I think part of what happened within this policy could have potentially been avoided. I don't know, Bruce, correct me if I'm wrong. Maybe you couldn't have seen this on the illustration, but I think you probably could have because the cost of insurance and the charges showed up at about 6.6 million and he says that it was 88% of premium. And if you had premium going in, 88% of that premium is cost of insurance and charges, you would end up with a really tiny amount of cash value in the first
Yeah.
year. And frankly, there should not have been an excuse for the the cash value to be that low in the early years. We don't design policies that way, and we know about how much percentage of your premium should be available in cash value in year one, two, three, four, and when that should look like a break even. And my guess is, I'm not looking at the illustration, but my guess is this was nowhere close to that. If 88% of the premium was used up in cost of insurance and charges, that means the amount of cash value available was at maximum 12% of the premium in year one. And it
Yeah,
probably wasn't even that high.
I don't know how that was, and this is what Bobby is saying is like this thing was set up to fail. I don't know how the illustration could have actually showed this being successful in the future, but he does say it was showing to take out that but $787,000 for 30 years, right? From age 50 to age 80.
Mm-hmm.
That and then it would be out. Yeah, so I don't know how it was. I guess he made a decision he was not going to put the actual illustrations in the article. But I just want to point out just a few more things that this was more incompetence of the agent than the strategy that could have worked. Because the other thing he commented that was because the first 3 years of this policy, the cash value was allocated into a fixed account of 2.25%. So that was all it could have earned. It couldn't even earn what they were illustrating of close to 6.09%. The agent made a mistake for what some kind of reason, put it in a fixed account. In other words, an account that can only make 2.25%. And the S&P 500 during that time period was 16, 13, -8, 21, 21% when the Bushes had these policies. So they could have made a lot more. Now they couldn't make there was caps on this. They couldn't have made the entire amount, but they could have made quite a bit more than 2.25%. But when it's in the fixed account, you don't get the upside of the situation.
Which you would think if the agent was designing this for himself to ensure that he would get a really high commission, he was clearly attentive to making modifications to the base illustration to change it in that favor. You would think if he was competent enough to make some tweaks that were really in his favor, he would have also been competent enough to make the tweaks that would have been clearly in the client's favor to make sure that that premium went into the crediting account to actually earn when the S&P gained rather than putting it in the fixed account where it had no opportunity.
Exactly. And a couple other things as we continue. So I'm sure the lawyers are going to point out that they committed to putting 1.5 million in for 4 years, which would have been $6 million. Well, they committed it for 5 years, but what happened in the first 4 years of the policy, they just put in 3.75 million. So they only put in 3.75 million, but they were planning on putting 6 million in according to the illustration. And then Bobby says he made it estimated policy charges of 4.15 million. So there's no way that this policy couldn't lapse because they weren't putting enough money in. And I'm sure this is what happened. The insurance company said, if you do not pay this, this policy is going to lapse. And the Bushes were saying, now, wait a minute. The illustration says I have this much cash value. I don't understand what happened here. So the Bushes could be held responsible for some of this, but as Bobby Samuelson is saying is, even if they would have fully funded it, this thing was still set to fail.
Yeah, I think this is just so interesting. I mean, we take so much caution and precaution and care to ensure that we take our clients through a long education process and we ensure that they understand the decision they're making and they feel really competent and they have the disclosures and they have the illustrations, and we also communicate that the illustration is just a projection in time, and now there are a lot of moving parts of life insurance. The basic structure is you pay the premium. If you're working with a whole life insurance policy, I'm just going to make sure that I throw that caveat in. If you're working with whole life, you pay the premium, you have a guaranteed cash value, you have a guaranteed death benefit. And in my comfort level, that is what I'm comfortable with communicating about, and it's what I'm comfortable with owning personally. I am not comfortable with the nuances and potential for challenges that come with IUL policies, but it seems to me that there was a lot of lack of disclosure that was happening.
Yeah. Um, just lack of education. I'm not even sure it was purposely done. I've had clients over the years that said, "Hey, I get the gist. Let's just go with it." And you have to fight that with those people and say, "No, I want you to understand each part of this." Maybe the Bush is same thing. Maybe they got a referral from this person and they just said, "Hey, this is a wonderful thing." What I've also learned, Rachel, is greed works on both sides. The agent's greed, but also the greed by the Bushes. Oh, you mean I could put in $1.5 million for 5 years or 7.5 million, and then I can get $787,000 for 20 years. I'm doing the math right now. That's $15 million, $15.7 million. So they're saying, hey, I put 7.5 in, I double my money that I get out tax free.
And maybe that's all they understood about this.
Yeah,
We don't know.
yeah, we have no idea. We have no idea. The last thing I'd just like to say about today, though, is once again, these are the opinions of Bobby Samuelson, who throughout my career, I respect his opinion, but I did not see the illustrations. Okay. I didn't see the lawsuit. I did not see the emails or anything like that. But we do know that they put millions of dollars into a policy and it's no longer available. And so something went wrong. And Bobby's is saying it's basically from all intents and purposes, it's the insurance company and it's the agent, and maybe just a little bit the client's fault. But remember, he's saying that even if they fully funded it, it would not have prevented it from lapsing.
So I think the question then really is, so where do we go from here? How do we not take this headline and let it impose fear in our life insurance decision making? How do we move forward knowing that we can make solid decisions about a product that is really good for us, not be afraid of the complexity, not be afraid of the label life insurance and run away from it thinking, well, this client lost millions. What if I lose millions too? How do we not let that headline be a scarcity tactic in front of our minds and still make really good decisions and prevent, how do we protect ourselves from that kind of error when using life insurance the way it should be used?
You know, the um, the bottom line is you need to work with somebody that is going to take the time to show you all the different components. And this Index Universal Life platform or any Universal Life platform does not have guarantees like Whole Life has. What's interesting also, Rachel, I was trying to compare this so people could think about it compared to something else they might think about, but yet they still do it. And I was thinking about the stock market. I mean, people know of people that have lost money in the stock market, all their money in the stock market, and yet they still invest in the stock market.
That's a
Uh,
good point. Yes.
so why would you all of a sudden say, well, that one person or these people lost money in this, so I'm not going to do that? It's a mindset that needs to be overcome, and I understand why people need to overcome it, but you need to work with somebody that's willing to go over all the different aspects of this and realize that if you want this thing to happen from age 50 to 80, if it has to happen, then you might want to use products that have guarantees on them.
That's well said. Bruce, I think what you're saying, if I could just put it in my own words, that if we take a situation that happened to a particular person with a particular agent, with a particular company, and a particular product, and in a particular situation, and we generalize that to all life insurance, that's a gross overgeneralization that's not helpful to you making decisions. And I think there's some very clear red flags that happened here. First, you should never think of or communicate about or receive or accept if anyone tells you this Never accept that life insurance is an investment. It's absolutely not an investment. It is not a risk-based growth tool for growth and acceleration. It is a tool for providing a death benefit based on the premium that you put in, and it provides cash value along the way. And in my humble opinion, if you want to have the best version of life insurance to have the most guarantees, you are going to use a whole life insurance product, not an IUL. Part of the challenge with the IUL, VUL, variable universal life world is it blurs the line between investment and insurance, and it makes it really confusing. And when you hear life insurance is an investment, which again I say is not true, if you hear that, it's really confusing in that world that has some investing component connected with the life insurance. I like the purity, the clarity, the guarantees of whole life insurance. The second thing is that I would really encourage you to, when you're walking through an illustration with your agent, to be watching for several things. First of all, what is that long-term performance looking like on a guaranteed basis, not a projection based on non-guarantees or expectations or stock market doing a certain positive return. I would look at what is the bare minimum performance of this illustration if everything is as flat or as unimpressive as possible. What is that? And what does that look like on a long-term basis? And what does that look like on a short-term basis? Because some of these flaws of super high costs are going to show up if you do look at those first, second, third, fourth, fifth, sixth, seventh year cash values, especially on a permanent life insurance product. And you're never going to have 100% of your premium available in cash value. There are costs up front, but you should have an agent that's willing to talk about commission and willing to talk about those costs so that you can understand them and still have a tremendous benefit in the amount of cash value you have early and upfront.
Yeah, guarantees are always, the insurance companies actually had whole life first. Then they were losing market share to investments. So they started to blur the line to try to get more of that market share back to insurance type products. And they tried to mix securities-based products with insurance. And it hasn't turned out really very well for companies that focus on that.
So this is not a reason to be scared about life insurance. This is a reason to do your due diligence, ensure that you understand what you are purchasing, and go through an educational process. Don't just look at three numbers and say too good to be true. It's awesome. Let's go with it, and I'm going to trust that they're doing everything in my favor. It is really important for you to be a educated and wise and equipped consumer to understand the decision that you're making. So Bruce, is there anything else that we need to cover or closing remarks? Anything that's top of mind that you want to leave our listeners with today from this conversation?
The only thing I wanted to do is not to bring an alarm to this and say, this is a bad situation and you need to totally be leery of index universal life. Um, I still believe if a person understands all the risk, they understand all the risk and they understand how this is going to be designed, that there's going to be some people that are going to choose this for estate planning purposes. Okay. But that's different than if you're choosing it for banking or if you're choosing it to take passive income off in the future, because both of those situations put a lot of stress on the policy because you have a different interest charges on those loans. And that puts a lot more stress on the policy. If you're just doing it for the death benefit and you don't plan on accessing any of the cash, whether through passive income or loans, then and you understand that the only the only thing that could possibly go wrong then is you not fully funding it, and um, you might not get the crediting that was reported, but you can then take money off the sideline and pay the additional premium. Then it could work for that situation. But for what they were trying to accomplish, you have to be a very astute observer of what's going on. With whole life, because of the guarantees, you know, your risk factor is brought way down. We never want to say it's zero, but it's as close to zero as you can feel comfortable saying.
Mm. And I think that's really helpful. So, if you've listened today and you have questions about this particular situation, or you have questions or concerns about your particular life insurance policy or a policy you're thinking of purchasing, or you just want to talk through life insurance and your particular needs and really address your your goals, your financial situation, and your concerns from a holistic perspective to ensure that you're making the best decisions and getting the education that you need to fully understand your decisions along the way. We'd love to have a conversation with you. And that is what we do on a regular basis with our team at the Money Advantage. And so I'd encourage you to book a call. This is a no obligation call. It's an introduction to feel out our team if we're the right team to be able to help you navigate these waters. And so you can do that by going over to themoneyadvantage.com. Right on that homepage, there is a button that is for booking a call. It takes you directly to our agent's calendar, and you can go ahead and book that call to get started with that conversation. And we encourage you to begin that conversation if that is something that is of interest to you as you're building your best capability and competence for a long-term future that does have controls, does have guarantees, and has the ability to control capital. And so we'd love to be a part of that conversation. Thank you for listening today. And in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.